Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Pacific Basin Shipping Limited annual report. Pacific Basin Shipping Limited offers a diverse range of businesses and services to the shipping industry. At its core, the company provides dry bulk shipping services that transport various commodities such as grains, ores, logs, and fertilizers across international waters. In addition to shipping services, Pacific Basin also offers consulting, crewing, secretarial, and ship agency services to support its clients' needs. The company's expertise extends to vessel owning and chartering, allowing it to manage a fleet of 277 owned and chartered vessels. This includes Handysize, Capesize, and Supramax/Ultramax vessels. Furthermore, Pacific Basin engages in convertible bonds issuing activities, providing an additional revenue stream for the company. With its extensive experience and global presence, Pacific Basin has established itself as a leading player in the shipping industry, catering to the diverse needs of its clients through its comprehensive range of services. The Pacific Basin stock price has skyrocketed by over 97% in the past year due to a combination of strategic moves and key news events. Despite reporting a decrease in net profit and EBITDA for 2025 compared to 2024, investors have shown confidence in the company's long-term strategy and financial health. One major factor driving this stock performance is Pacific Basin's commitment to shareholder value. The company has demonstrated its dedication through share buyback programs and an expanded dividend policy. In December 2025, they completed a share buyback program, repurchasing and canceling 150.7 million shares for approximately $40 million. Additionally, they have approved a new share buyback program of up to $40 million for 2026. Another significant factor is the company's attainment of a strong net cash position. By the end of 2025, Pacific Basin achieved a net cash position of $134 million, a substantial improvement from the end of 2024. This financial milestone has reassured investors about the company's financial resilience and flexibility for future investments or capital returns. The strategic fleet development and renewal have also contributed to the stock price surge. In December 2025, Pacific Basin announced a strategic order for 4 new Handysize vessels, scheduled for delivery by 2028. These vessels are designed with enhanced fuel efficiency and greater cargo carrying capacity, positioning the company for future growth and fleet modernization. Lastly, Pacific Basin's resilience amidst geopolitical challenges and market dynamics has bolstered investor confidence. Despite navigating a challenging environment marked by U.S.-China trade tensions, disruptions in the Red Sea, and evolving IMO net zero regulations, the company demonstrated operational agility and resilience. Pacific Basin Shipping Limited market capitalization of $16 billion is materially smaller than most of its industry peers of roughly $39 billion. Pacific Basin Shipping Limited trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 1.13 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 24% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.76%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline are multifaceted. On the growth side, companies have benefited from outperforming TCE earnings, stronger freight rates in the second half of 2025, and a resilient minor bulk segment. Additionally, core business contributions and operating activity contributions have also driven revenue growth. However, on the decline side, dry bulk supply has grown at a faster pace than demand, leading to weaker freight markets. Furthermore, a decrease in freight revenue has also contributed to the decline in revenue. These factors highlight the importance of balancing supply and demand in the industry to achieve sustained revenue growth. The financial performance of a company underwent significant changes between 2024 and 2025. A notable decline was observed in net income, which plummeted by 56% from $131.7 million in 2024 to $58.2 million in 2025. This substantial decrease in net income is a cause for concern. The profit margins of the company also experienced a downturn. The net profit margin decreased by 2%, dropping from 5% in 2024 to 3% in 2025. Furthermore, the return on average equity, ROAE, declined by 4%, falling from 7% in 2024 to 3% in 2025. These changes indicate a decrease in profitability and efficiency of the company's operations. The company's financial performance indicates a strong ability to generate cash from its core operations. A key indicator of this is the net cash inflow from operating activities, which stands at $134 million. This positive operating cash flow suggests that the company is efficiently managing its day-to-day activities and generating sufficient revenue to cover its expenses. This significant amount of operating cash flow is a testament to the company's financial health and stability. It also provides the company with the necessary funds to invest in growth initiatives, pay off debts, and reward shareholders. Overall, the positive operating cash flow is a crucial aspect of the company's financial performance, indicating that it is well-positioned for future success. The company's debt level and interest expenses have undergone significant changes in recent times. On one hand, the total borrowings increased by a substantial plus 48% from $262.3 million to $386.5 million on page 14. However, this is contradicted by other pages, which show a decrease in non-current borrowings by 62.5% and a reduction in total liabilities by 22.7%. Despite the inconsistency, it is clear that there has been a notable change in the company's debt level. In terms of interest expenses, finance costs have decreased by 13% to $130 on page 13. Furthermore, interest expenses have also seen a decline of minus 21%, from $17.8 million to $13.8 million on page 14. These reductions indicate that the company has managed to decrease its financial burden through effective management of its debt and interest payments. Management is optimistic about the company's future prospects, emphasizing a continued focus on countercyclical investments and growth opportunities. To achieve this, they plan to maintain a disciplined approach to fleet growth, prioritizing cost-efficient management through in-house functions. A key aspect of their strategy is operational excellence and digital transformation, aimed at driving long-term sustainable returns. The company has set strategic priorities for 2026, which include growing the business through disciplined fleet renewal and acquisition, refining its cost structure to maintain competitiveness, transforming its fuel strategy to comply with decarbonization rules, optimizing voyages through digitalization, and enhancing performance and shareholder return. Overall, management's outlook is centered on sustainable growth, operational efficiency, and adaptability in response to changing market conditions. The company has made significant investments in its fleet expansion through acquisitions. 4 new Handysize vessels with a capacity of 40,000 deadweight tons are being built and will be delivered in the first half of 2028 at an estimated cost of $119.2 million. Additionally, the company is exercising purchase options on 3 Handysize vessels and 1 Ultramax vessel that were previously chartered long-term. In terms of divestitures, the company has realized gains from the disposal of certain vessels, amounting to approximately $40 million. This indicates a strategic decision to streamline its fleet and focus on more profitable or efficient operations. The company's financial activities have been quite active. One notable aspect is its commitment to rewarding shareholders through dividends. As per the records, the company has indeed paid out dividends on multiple occasions, with specific mentions in pages 1, 2, 4, and 20 of the report. In addition to dividend payments, the company has also engaged in share buybacks. This strategy allows it to repurchase its own shares from the market, potentially boosting shareholder value. The records indicate that the company has bought back shares on several occasions, with mentions in pages 2, 4, 14, and 22 of the report. Overall, these actions demonstrate a proactive approach by the company towards managing its finances and rewarding its shareholders. That concludes the financial summary for Pacific Basin Shipping Limited. Feel free to comment below, and I will be happy to answer them when possible.